Welcome back to another week of the Educated Homebuyer Live with Josh and myself to answer your mortgage and real estate questions, update you on the economy, what's happening with mortgage rates to help you become educated homebuyer. So Josh, we've got rates still moving upwards. We got CPI coming in line. What are we going to talk about tonight?
We're
We got a
probably
new
going to talk
president,
about
but we had one last week.
Yeah, we had that last week. You're weeks behind there. If you guys at home watching are picking up any tension between Jeb and I, it's because Jeb is mad that my technology wasted his entire day. So any of the small technological snafus you guys have witnessed at the beginning of shows pale in comparison to my incredibly fast, overspec'd computer causing us problems all day and wasting at least 50% of Jeb's day.
Yes, we tried to film our podcast for next Tuesday today, and 2 or 3 different times, and Josh's computer failed us every single time. So we still don't have that episode for next week, but we do have this past episode up where we talked about Trump's policies, how they're likely to affect housing. So if you haven't done so, go check it out. We're currently sitting at 4,990 subscribers, Josh. We are 10 subscribers short of 5,000 subscribers. So if somebody tonight is not subscribed,
they could be the 5,000th sub.
Been on the podcast. We got 2 years, just over 2 years. We got the email today. So anyhow, guys, we are here to answer your mortgage and real estate questions. So start putting them in the chat. Let us know where you're watching from. Let us know topics you want us to cover. Anything. We're open. We're fair game today. Josh and I are so laid back today because everything has gone wrong on this side that we're open.
Cool,
we're open for
collected.
Career changes, job opportunities, anything you got, we will consider.
Jeb, I still say we fall back on my plan that we just open up a golf cart shop and a YouTube channel just talking about golf carts. How much more fun would that be if we cracked a beer and we're just talking about customizing golf carts?
You froze, and I'm going to lose it. Here we go. So Josh has been freezing all day. That's part of the problem with the camera here. So if we get a little bit of delay, guys, bear with us. Something's going on computer-wise there that's keeping us from being able to stream like we normally do. But I am going to take it and dive into our charts as we always do while you guys start putting your questions in, and then we can hopefully get back to Josh here as we go through, and everything's going to work out as it should. So this week we saw a noticeable drop in inventory nationwide. We went from 735, 718 down to 721, 576. We'll talk about where the peak is for the year, which we've already hit. But inventory should continue to move down from this point forward. So unsold supply of homes, as I mentioned, peaked 3 weeks ago. We have 27% more homes on the market this time right now than we did last year, but we're down from September. We were sitting at 40% of homes on the market at that time. So we like to look at Orange County and Huntington Beach because that's where we're located. Huntington Beach, or Orange County rather, up just a small tidge, just less than 0.5% up week over week, sitting at 3,490 homes, whereas Huntington Beach is sitting at 230. Both are below the peaks of this year, but not falling nearly as fast as I thought they would getting this close to the holidays. So more homes are staying on the market versus continuing to decline. The closer we get to the end of the year, in theory, the less homes we should see, but there's a lot of different factors playing in right now, and nothing is normal at the moment. That's for sure.
Nothing's been normal for a long time, Jeb.
No, for sure. This looks at the second report from Calculated Risk, looking at housing inventory. We like to show this when it comes out, but it just compares things year over year and then versus 2019. So this is, again, look at active inventory. As we can see, most markets are up year over year. In fact, all these markets that he's reporting are up year over year. Jacksonville sitting at 80.4% up year over year, with Connecticut, I think, being on the least of this at 7.7%. But then when we compare it to 2019, you got a mixed bag, Josh. You know, for the longest period, most of these areas were still down compared to 2019, whereas now it's split. You know, Jacksonville's still the highest, 53.1% compared to 2019 up. So inventory up considerably since then. Whereas you have some markets that are down, Las Vegas, Grand Rapids, Michigan, Albuquerque, San Diego, but then also some also up at the same time, with Denver being one of those. So again, just like to keep track of this, just because inventory kind of tells the tale of what's to come, if you will. Because if inventory continues increasing, then you're probably going to get a little bit of pressure on prices, especially with rates staying higher. So new listings, 48,863,000 new listings unsold this week. We compare that to 2023 at 55,000 and 2022 at 52,000. New listings are less, but I mean, we still are getting more homes coming to the market, which is a positive sign, just based on this time of year. Again, new listings, calculated risk. I'm not going to go through this. You can take a look at it year over year versus 2019 if you're interested. If you're watching or listening rather versus watching, we can put these slides in the show notes. We stopped doing it a while ago because basically people weren't viewing them. But if you're interested, let us know. We can make sure that those charts are in there so you can take a look at them.
So make sure you watch, because we need to see high counts or we stop doing it.
Yeah, baby. Nobody's opening. So why continue to do the work? Same week last year, I said inventory this week, we're at 721,000. We're still up 28%. Last week, same week last year, rather, we were sitting at 566,000 homes. So the peak right now for 2024 is at 739, which was 3 weeks ago, but inventory will continue to decline throughout the rest of the year. Pending home sales, 336,224. That's 11.5% more than last year. Property or price reduction sitting at 38.8%. We're now below 2022 and 2023 with price reductions. And so these charts came from Sacramento Appraisal Blog. I don't know if you guys know who Ryan Lundquist is. He's an appraiser up in Sacramento. He runs Sacramento Appraisal Blog. So if you're in that market, definitely something to pay attention to, because he follows the data there more so than anything else. But he took the time to send us these charts and just shows real estate prices over time in California. Now, for those of you in California, you don't really care, but it's nationally, it follows something similar. Maybe not quite the appreciation, but a similar pattern over time with those. But you can see, Josh, I mean, we've had a heck of a run in the last 50 years with regards to real estate prices.
Well, Jeb, I'm only 51, but I've owned my home for a long time. So we went through this afternoon. In 2002, I ran it through a calculator, and I was a little bit surprised. I would have thought the number is astronomical, how much it's gone up. It's tripled in value. But we bought in late 2002, and through to today, it was about five and change annualized over that time frame. So part of that happens to be that we saw a nice little run up. We suffered through the biggest dip that the United States has ever seen in home values, and then we've now benefited from the biggest run up. So hard to say. You guys like to ask us questions. What happens next week, next month, even next year? Hard to say in a 1, 2, 3 year time frame. Over a 10, 15, 20 year time frame, you can see what the chart does.
Yeah. And then here's a similar chart. This is just adjusted for inflation. So a lot of people say, we're at the highest ever with regards to home prices. Home prices have never been this high. Well, when you adjust for inflation, they actually have. We're actually below that peak. The peak back in 2006, as well as 2022.
And Jeb, this chart and charts like it are very valuable, because what you'll want to see consistently higher highs. So homes have been becoming less affordable for 50 years now, and that trend is unlikely to change. That doesn't mean they're not going to be more affordable than they are today. It means that they will continue to just see higher highs. And even on the downside, you can look, we have lower lows on this chart. That is an uptrend, and that is an uptrend that is unlikely to change due to supply demand dynamics. Jeb, blast from the past, a year and a half ago, we did an episode of the podcast on that silver tsunami, and demographics do turn against us here sometime in the next 10, 15 years. That could impact it, but I wouldn't bet against that trend continuing into the future.
Josh, you said that about mortgage rates being in a 40-year downtrend, and then
I jinxed it. Am I the jinx? Should I just stop talking about long-term trends?
Let's not do long-term trends. Let's just say, whatever happens. We don't know. Housing affordability in California and Orange County. Most of you, again, care so much about these charts, but we like to put them in there because, you know, it kind of tells what's going on. But then anyway, this shows from 1991 to 2005. You can see how, you know, where affordability was 2005. I mean, near lows at that time. And then where it went and where we are now. So we're, you know, we saw that big boom between, you know, 2007, 2011, 12. Affordability was in a lot different place just because of where prices were at that time. And then at the beginning of COVID, we saw another spike because rates coming down. And ever since rates have been going up, affordability has been getting worse. So just again, he supplied these charts. I thought they were useful and wanted to put them in there for you guys to take a look at. So Josh, what are we looking at with consumer sentiment? This is a pretty interesting chart, actually.
I think it's a super interesting chart. So a couple of corollaries to what this chart is telling us. We talked about on that episode when we were comparing and contrasting Kamala's plans and Trump's plans. We talked about presidents get too much credit when things go good, too much blame when things go bad. We have another saying, things are never as good or as bad as you think they are. And this kind of goes along with it. So you see the red and the blue lines crossing. Consumer sentiment, when it's separated out by political affiliation, if your party is in the White House, you feel a lot better about the economy. So remember, when we say things are neither as good nor as bad as you think they are, this is true for if you hated the economy for the last 4 years, probably wasn't as bad as you thought. If you loved it and thought it was wonderful, probably wasn't as good as you thought. And now we haven't even had a change, but we've seen those lines crossing or meeting there over the last week or so. So just thought it was interesting. Just remember, Jeb likes to talk about control the controllables, the things that are under your control. You get to vote, but we don't get to control who's in the White House. We don't get to control policies. You don't get to control your neighbors, what they do, the choices they make. Just control what you can. It goes a long ways towards peace. It's easier said than done, right? For all of us.
Control your philosophy, Josh, your philosophy.
All right. Well, this one here, Jeb thought this was super interesting. We can see two things in this chart. Loan originations way down in the busiest part of that refi purchase boom during COVID, 1.2 trillion in quarterly originations, and now we're just a hair over 400 billion. So about 65% down from where it was. But the thing this chart is really trying to show you is how much of that volume we're talking. 60% of it is going to people with credit scores 760 and above. So the comments that we get on the podcast channel, I'm sure you get them on your channel also, Jeb, is who's buying? Who can afford this? Definitely people who are in stronger hands, more savings. If we had that chart, it would see bigger down payments, higher incomes, higher credit scores. So just wanted to throw that one out there and show you the big data we got today. Jeb, you hinted at it, consumer price index. I don't love either one of these charts. Barry Habib, previous guest, puts these out. I just don't like the scale on there. You can't really tell how much is moving. But with both of those, you can see both core and headline CPI have been decreasing, but have gone the wrong direction here recently. We talked about base year effects and how that plays in. One of the things that folks have liked to look at is both the annualized rate and then the 3-month annualized, 6-month annualized. So core 3.3 today, but over the last 3 months, it jumped up to 3.5. The 6 months before that, it was at 2.5%. So we're going to look at something that tells us, barring something unforeseen and a spike back up in monthly reads, we're going to continue to see that moderate, but it's not moving in the direction or as quickly as the government would like. For you watching at home, I thought this chart was interesting. Food prices from January 2020 forward here. January 2020 was 100. But looking at that, we had this big run up from 22 to 23. And now we're kind of the slope of that line, the trend, the pace of increases is pretty much normal. But none of us want to hear that, because the part in the yellow dotted line, you can see what a big run up that was. So the fact that the rate of inflation is under control does not account for the level of prices, which most people are unhappy with. So this is what we were talking about, Jeb. This is actually the headline, not the core. But you can see we've had 4 straight months, 0.2, 0.2, 0.2, 0.2. So it equates to 2.4 annually. So it's not much above the 2%, but it's been pretty consistent there. And remember, we talk about this all the time. They round. So some of those months were a little below 0.2, some were a little bit above, but they've all rounded to 0.2. We are going to have, so that actually October 23 fell off. The next 2 months, November and December, are going to look like a lot about like the months that are coming on, most likely with 0.2 figures. So we're going to have to get into the spring before we see big numbers falling off. And hopefully we see this figure here. Dog's over here shaking like crazy. Hopefully you guys didn't hear that.
We definitely.
So here's the core inflation rate. I wanted to show you guys this. So that downtrend is absolutely intact. That green line is good, but you can see from May, June of this year, where we had that nice 0.1 reading, definitely has increased, and we've sort of leveled off here. We don't want to see that blue line end up above the green, so we'll be watching that. The important thing, Jeb, to know, core CPI, excluding shelter, was only up 2% year over year, is exactly where the Fed would like to see it. So the excess inflation in the economy right now is currently shelter costs. You guys are here watching a housing podcast, a housing live show, and you're going, yeah, no shit, prices are too high. Housing is too unaffordable. But this is actually just capturing the rate, and that rate is coming down, still elevated, but coming down, and it hasn't been captured in the data yet. So on the upside, part of why the Fed remained accommodative way too long is you see this dip here in 2021. It took way too long for it to account into the inflation figures and show an accurate picture. It's taking too long on the downside. So it'll be interesting to see how that plays out. This shows you actual rent measures year over year. So Zillow, CoreLogic, Apartment List, they all show that rents are moderating. Yet when we look at the figure that is captured inside of CPI, still at like 5% year over year. So we'll see how that moderates over time. What post CPI is the futures market saying? Still expecting 80% chance that we get another cut in December. If we do, 60% chance that we're not going to see anything in January. And then across the next 3 meetings, it's like a 50-50 proposition that we're going to get another cut. So between now and the middle of next year, the market is thinking definitely 1, probably 2 more cuts. And it's all going to come back to the things that we're talking about. And really, we're not going to go too deep into it tonight. Jeb and I should have already recorded an episode of the podcast that goes on a deep dive on that. So by this time tomorrow, we'll have it. And by next Tuesday, you'll get a look at it.
Well, Josh, let's go back to that. Let's go back to that
Sure.
chart real quick. Yeah. And so guys, see that, again, we talked about this previous to the Fed cutting 50 basis points, but see how the market is predicting these things to happen. The reality is when these things happen, very little effect's going to happen in the market, right? Because the market's prepared for this. The market is building this into their forecast to market predictions going forward. Now, maybe they're not looking all the way out to July at the moment, but they're already thinking December, there's going to be an 80% chance that there's going to be a 25 basis point cut. So when that cut happens, you're not likely to see a move in mortgage rates, in improvement at all, because again, the expectation is already there. Now, how do we get a bigger move? How do we get a surprise move? If these predictions get more aggressive, if the Fed changes the language in their statement, that sort of thing. That's how we get changes. Right now, transparency from the Fed, or this isn't from the Fed, but transparency from traders on what the Fed's likely thinking based on their comments. And so, regardless, they do 3 cuts, Josh, they do 4 cuts, still restrictive. Very little impact on mortgage rates, on maybe mortgage spreads improve a little bit, but overall, not going to be a big mover either way.
Yeah. And if you guys remember, we had pretty much a straight blue line down all the way to almost the bottom left of this before the first Fed cut, and mortgage rates had improved. The futures market was, just as Jeb said, already pricing that in. And now they've taken that away and we've seen rates go up. So for the most part, we're somewhere in the range of where we should be. So which takes us to this chart here. You can see our channel. I zoomed out all the way back to October of 23. That's the peak on the 10-year treasury at 5%. That red line is that downtrend line. You can see we've poked above it. That is not good. The other, those colored bands there are Fibonacci retracement levels. Right now we're at 446. We are right there below a 61% retracement. If we blow through that, the next level is the 76% retracement, and it's at like 4.7, which 4.7 was the peak on our way down. We don't want to see those things happen. My feeling is this is fear-based. fear out of uncertainty. A lot of the comments you guys have over here, what if Trump does this? What if Trump does that? How is this going to impact the economy? No one knows. We're not political experts. We're not economists. We follow it closely. We read a lot. We try to bring you everything that we know. But the reality is nobody knows. And there's going to be volatility, fear, and uncertainty in the market for 2, 3, 4, 5, 6 months until this plays out. And I think it will settle out and that downtrending red line will come back into play. But for the time being, it is time to play defense. I talked to a listener that I'm actually going to get to talk to after the show tonight. She reached out and their loan officer was being very, very helpful and said, no, we don't want to lock. Rates have gone up a bunch. We're going to wait a few days and see if they come back down. They've done nothing but suffer through that because someone didn't have the ability to show them the chart. Show them this is not a crystal ball, but it is equivalent to counting cards in blackjack. So you know when the odds are in your favor. It doesn't mean the next card is coming your way, but it lets you know when the odds are in your favor and when they're not. And in the current situation, they are not in our favor. We've got a bad shoe, so you don't want to be betting heavy right now.
Well, let's talk about that for a sec, Josh. Not that per se, but just in general. What has been moving the market recently? The election, right? The outcome of the election, who was going to win, Congress, if you will, still up in the air, but I guess pretty, they're thinking it's going to be a red wave. It's going to be a Republican. So you've got the election playing volatility in the market. You've got jobs reports. You got CPI. Really the biggest three movers in the market month over month are the last two. The election hasn't been so until probably the last 30 days or so. But the reality is we don't have CPI just came out today. We don't have that again for another month. We don't have jobs report until the first week of December. You don't have a lot of data other than jobless claims week over week. That's really a big market mover. You get some commentary from the Fed here and there, but stuff doesn't tend to move the market big in either way. Small moves here and there. So the reason I bring this up is because we're at this level. The likelihood of us going higher without data, probably pretty low. The likelihood of us moving lower without data, probably pretty low. So we're kind of in this, we're a sticking point, if you will, in my eyes. You got to see something one way or the other to move the needle in a meaningful way to either get back into that trend or push us far enough out of it that, now we're above that. So I think we're on the same page with that. But for people out there just looking at the market going, what's going to happen until you get something meaningful one direction, probably not much. You're just kind of in this weird spot. We had this, when rates were sitting at that 4.2 or the 10-year was sitting at that 4.2 level forever, and we couldn't break 4. We couldn't do anything until something came out that was meaningful. And so here we are again.
100%. So what does it mean for actual interest rates? Mortgage News Daily is talking 7.01. Again, super well qualified borrower. Someone here in the comments had asked 40% down, 800 credit score. What am I looking at today? You're going to be under 7%, but you're going to be pushing that level as of today. FHA and VA 6.3 reported here. We talk about that's always a little bit high. Again, 640 plus government borrowers are going to be paying less than that. Very important. Reach out. Get an actual real quote for your situation. This gives you a good idea. I like this chart because it shows the daily change, the weekly change. Doesn't tell us much here. It says they were better. That just tells us they were much worse within the last week. Up a good bit from last month. And look at that 52-week range. We're at the middle of the 52-week range. So hopefully we keep trending back towards the bottom, but that is what it is. We've had a bunch of you guys. I think we've got about 40, 45 of you now on this mortgage rate watch. If you, it's not for people looking to buy. Watch the show each week and we can go and tell you what's happening with interest rates. It's for those of you that bought in the last couple of years, that you have one of those high interest rates, 6.5, 6 3/4, 7 1/8, that missed the window 6 or 8 weeks ago that we had of lower interest rates. We do believe that they're going to come back. No guarantee, but with this, give us a little bit of basic information, give us a copy of your mortgage statement, and we can put it into our system and it will ping us to let you know exactly when it is time to start considering a refinance. One little note on that, Jeb, we've had out of the 40, 45 people who have signed up, a couple people get really, really sort of worried about sharing their mortgage statement. if you look at your mortgage statement, there is no non-personally identifiable information on there. Yes, it's going to have your address. I do look at people's addresses all the time, all day, every day. It doesn't have your social, doesn't have anything of that sort. It does have all of the information that we can plug in, including your location, that lets us know exactly when it would make sense for you to consider refinancing.
Good stuff. So you can go to theeducatedhomebuyer.com/rate watch, or if it's easier, jebsmith.net/rate watch. So either one gets you to the same place, same form, get you in there. And then lastly, if you're in any of the red states on this map here, looking to buy, sell, refinance, whatever it is you need help financing, our team here can help you. If you're in one of the blue states, our team can still help you. So basically anywhere nationwide, if you need help, reach out. We would love the opportunity to guide you through that process. Josh, I don't know, how many people have we helped this year? 50, 60 people from the show, probably,
yeah,
at least.
Yeah, and
So,
and more than that, just in terms of helping folks answer questions. Maybe they're in the
Yep.
process. Maybe their loan officer couldn't explain something. So if your loan officer can't explain something, maybe start with us from the beginning. But it does. We do talk to people and just kind of walk them through some stuff. And a lot of the time, they're either too far down the path or they're in a state that we don't service. We're happy to help. Just reach out.
All right, good stuff. So we've got a crazy question here, Jay, or Josh, from Jay, asking, what do you think would happen to housing markets if legislation passed to get rid of property taxes? I mean, first off, there's no world in which they could get rid of property taxes. They would have no money.
world.
Yeah, the states would have no money to do anything. But hypothetically, if they got rid of property taxes, you would see home values go even higher because the cost to own that home would be less, and probably push prices up, in my opinion. So, but anyway, Jay, we don't have to go far down that rabbit hole because that's not likely to happen.
Just a couple of thoughts. You're right. We don't need to go super deep on that. States can't afford it, and it would only benefit people who already have assets, aka homeowners. So if we're going to be running bigger deficits to benefit a group, it is certainly not going to be homeowners. So we don't have to ever worry about it, but it would increase home prices because we've shown over time, home prices adjust to reflect a percentage of household income towards the payment. If that payment gets lower, then you can allocate a greater percentage in the form of a higher purchase price. So, Jeb, we actually on sort of the topic of the rate watch, we got a really good one here. If we refinance, we have Jamie, a viewer here, refinance with us. If we refinance with you, are we automatically enrolled in rate watch, or do we need to sign up? Automatically, it pulls everything in from my system. I do have to go back because it estimates your current interest rate. So I just have to go back once a month and put in actual interest rates for those of you who closed with us.
All right, good stuff. Alvin, hey guys, great show. Can you buy a house that sits on 5 acres of land, or is there a limit of lot size? What's the max lot size with house on the lot to finance with a normal house loan? Is it hard to get? So, Josh, what's a lender looking for when it comes to lot size?
Interesting timing on this question today. Jeb, we actually helped a listener from your homeland in Albemarle, North Carolina. Property was on 38 acres. And we had some concerns or questions with that because there is we were fortunate enough that the appraisal didn't pick it up as a working farm, but I believe his father-in-law farms part of the land. And if it is a working farm, it can run into some issues. But in terms of your simple question here, we're not going to give, so Fannie Freddie guidelines are not going to give value to anything above 5 acres. Doesn't mean it can't be above 5 acres. Their situation was 38 acres. We're just not going to give value to it because they don't want to say, hey, someone has 500 acres and then we've got a little $300,000 house on that. The acreage would be worth far more than the land or the property. So for the most part, it is not a problem. If you're looking at a specific property, definitely let your lender know, hey, we're considering this, and make sure you do a little legwork ahead of time.
All right, good stuff. Let's answer this one, Josh. Classic Eddie says, do you think rents will go up? So Josh, what would cause rents to change? So we looked at the rent shelter data earlier, right? And so looked at Zillow and a couple of other sites that report rents, and most of them are showing that rents are declining and or have flatlined for the most part. What would cause rents to reverse course and go the other direction?
So let's fall back on our answer to all things price related, supply and demand. So demand is likely to go up as less people can afford to buy homes. So people that are forming households, Millennials, Gen Z behind them, coupling up, having children, getting married sometimes, need more room. So we have an increase in demand. We have the supply over the last few years had increased. When rates were really low, builders were going bonkers, building lots of apartments. Unfortunately, they leaned towards the Class A, really nice stuff. So there's lots of super nice apartments. Maybe we get discounts on those, but for your bread and butter, comfortable, nice roof above your head, we're likely to have increasing demand over the years due to demographics. And we are now seeing less permits, less starts, less completions of multifamily. So a lot of stuff coming online this year, but we should start seeing it in the numbers over the next few years decreasing. So decreasing demand, increased supply tells us prices will go up, plus just the overall long-term implications of inflation. The Fed wants to see it at 2%. I mean, if we just hit 2%, again, over 36 years, your rent's going to double. And we've seen shelter costs of all sort for owning and renting generally go up at a higher rate than the general rate of inflation. And there's really smart people that we follow that think we're not going to be at that 2% consistently going forward.
And here's what I would say. Like real estate prices, it's local, right? So what's happening in Florida and Texas and Louisiana and Tennessee, whatever, is different than maybe the market that you're in. What I can tell you is I manage properties for clients. And I would say out of 15 or so properties, each, I would say about half of them get a year-over-year increase. And they all probably could to some degree. Some owners are just a little, holding back and not doing it every year versus every other year. But I would say worst cases, they're staying flat. None of them have gone down. We haven't leased a property for less than the previous lease. I don't know when the last time that happened. So if nothing else, rents are stable, more so than declining in most areas, I believe. But again, like Josh said, it all comes back to supply and demand. So Josh, MASH, not to be confused with Nash, made a comment earlier and says, if someone has a weaker tax file, like $50,000 annual income, is it possible to get a mortgage loan? And which loan is better, FHA or conventional, for a low income customer? My question to you is, does it matter? Do you base a loan on how much somebody makes, or is it something else?
Well, the debt to income ratio is very important. So your income dictates how much of a payment you can absorb into that. So at 50,000, a little over $4,000 a month, 4333 a month tells us that we're going to need a payment under 2150 if we have no other debts. So in terms of FHA versus conventional, if you have other debts, FHA is going to be more flexible. No guarantee for Fannie, Freddie, or FHA that you will get these ratios, but we do know the max. The max housing to income ratio with an FHA loan is 47%, but total debt to income ratio, you can go to 57. So if you have a car payment, you have some student loans, you have some credit cards, it's going to be more flexible because you can absorb your debts and your housing payment and go all the way to 57%. On a conventional loan, hard and fast 50%. So if you have $400 or $500 of payments, we're going to have to reduce that household payment so that the total debt to income ratio is under 50%. No guarantee that you're able to get a double ratio if you have no debt on a conventional loan, but well-qualified borrowers, we can have that expectation that you can get to a 50% on a conventional. Well-qualified borrowers, probably the majority of borrowers, FHA, are going to be able to get 47, 57 automated approval. Both of those do require automated approval because absent the automated, manual underwriting guidelines are going to be much stricter on both sides.
Good stuff. A couple questions here, Josh. So title of the video, housing market costs are about to skyrocket, with the idea that tariffs are going to play a part in higher cost to build. There's an article where that came from in the description of the video if you want to know like why the idea of housing costs going up. But there's some questions around it. And Joyce says, are you anticipating Trump tariffs to cause future mortgage interest rate increases to remain high? So they're asking about Trump tariffs relating to mortgage rates. So let's address that first, and then we can talk about Jeff's question about tariffs going away once manufacturing comes to the U.S. Because two different things entirely, but both around tariffs and both around something that's anticipated to happen sometime probably in 2025. So do tariffs affect mortgage rates, Josh? Could they?
Could they? They could. So how would they if they did? It increases prices. So people have said, well, it's going to cause inflation. If we have a one-time implementation of tariffs, that is a one-time increase to prices. So as long as they don't continue to get ratcheted up after the first year, just like we saw food prices in that chart being way too high, but the rate of inflation is normalized, you would see a one-time jump in inflation. We talked about this. The things that would fall under tariffs, the goods that are imported that would fall under tariffs are less than 7% of the economy. So I believe it's overblown in terms of the potential impact. But probably the most important thing to remember, Jeb, we talked about uncertainty and fear. The markets have this uncertainty. They think they have some certainty in terms of Trump, who we happen to know uses the microphone to move the goalpost. So if he wants X, he's going to talk about, I'm going to get X plus 5. So then when he only gets X, he looks like he compromised, but he actually got what he wanted. So he's talking about these 60% tariffs, whatever it is. There's some hyperbole in there because he's shown us over 30 years. That's the way that he operates and negotiates out in the public. So let's say that the 60% was the real number that he wanted. The fear of a red wave was not that everyone goes, oh my God, conservatives and Republicans are awful. It's that one party having unchecked power could be problematic. So if you get Trump with decisive majorities in both houses, then he says 60%, they rubber stamp it, and you have 60% tariffs. The reality is he probably doesn't even want 60%, and it will hit the rubber will hit the road when whatever he proposes works its way through the House and the Senate, and those congressmen and senators have to go back to their districts and go, hey, how is this going to impact us? Some of them are going to go, this would be great for my district. Others are going to look at it and go, well, this sucks for my district. And again, it's all a negotiation. Are we going to get some tariffs? I would be shocked if we didn't. Are we going to get anything like the craziest proposals that he threw out there? Also would be shocked if we got that. So in terms of, does it impact inflation? Does it push interest rates higher? Could, might. Is it going to have a massive impact? Is that going to be the determinant of what happens over the next 2, 3, 4 years in interest rates? I don't think so.
No, but let's talk about tariffs in things that it could impact, right? It could impact things that to build houses. It could be lumber costs. It could be a number of things, garage doors. It could be anything that is imported in. If that's the case, does the builder eat that cost, Josh, that one-time fee, or do they pass it along to the consumer to some degree, and maybe the cost to build that house goes up? Now that maybe the developer makes less profit on the deal and prices stay the same. Some cases, maybe the price of that property goes up to cover that cost, right? So there's unknowns. We don't know any of this stuff, but there's a lot of guessing on, the extremes of one direction or the other on how this will impact. And I think that's probably the scariest part for most people, is that everything is an extreme. It's got to be polarizing. It's got to be tariffs are going to drive the cost of housing up to a point where it's completely unaffordable. Probably not. But there could very well be some sort of increase in the price. Thoughts?
I look at it. No, just go back to everything with the media. Well, and we have like split media. If you want to hear one message, you've got channels that you can go to, websites you can go to and hear that. If you want to hear another message, you can go to another channel. Like I opened the Wall Street Journal today, Jeb, on my phone while I was eating lunch, and I was like, holy shit, am I reading the New York Times? Like, it was some of the most crazy partisan stuff I've ever seen, and it just doesn't seem like things that we used to think financial news wouldn't be impacted that way. Everything has a slant, because in the age of the algorithm, they know that if they give you a fair and balanced news report down the middle, no one wants to click on it.
Very true. If you want a fair and balanced housing report, though, come to us each week, because that's what we do here. Just giving you the facts. Jeff, following up to Jeff's question here, or comment rather, tariffs will go away once we bring manufacturing back to the U.S. So the cost to bring manufacturing back to the U.S. is obviously means probably higher labor cost and some other things. That's the reason a lot of this stuff isn't done here already. In the case, Josh, that we bring tariffs back, or tariffs are gone to some degree, because when we're now producing this stuff here in the U.S., higher cost, higher fees. What happens?
it raises the cost, but then again, and several of you have pointed this out in the comments, here's the theory of it all. It raises the cost. It makes foreign goods less competitive. So now it makes American goods more competitive. So we say, okay, we can build factories here. We can create jobs here. So we have higher wages, higher household income. So is there inflation? Yes, but the American consumer is better off. And they're not hypotheticals. We know that is how it operates if it plays out that way. It's just everyone has a plan until they get punched in the face. Well, we got a plan, and when it goes out there in the real world, it's going to get punched in the face a few times, and we'll see how it actually plays out.
And here's the last thing we'll say about that or on this topic, because we've touched on this. A stronger economy, more jobs, higher wages aren't signs that the economy needs lower rates. That kind of is the opposite, right? So if we have this thriving economy, everything is everybody's making more money. Price of goods are stable now because we're not having to outsource them or import them. These are things that show the economy is booming, which means you're not going to see probably 4%, 3% rates again. I mean, anytime soon. Until something, you need a slower economy. You need recessionary times. You need something to stimulate the economy to likely see a meaningful move in rates. Is that fair? Or can you have both at the same time?
I was reading the question, Jeb. I apologize.
It's all good. Can you have a booming economy and lowering rates at the same time?
Not really. Not really, because at a certain point, that booming economy does become inflationary. So maybe the government lays out and says, we're not going to be restrictive, but we're certainly not going to be accommodative and keep rates lower. So the two are mutually exclusive in terms of really low accommodative interest rates and a really strong economy. You could probably what we all should best hope for is something in the middle. What if we got to an economy that was growing 2.83% a year and we had mortgage rates at 5%? Most people right now go, that's pretty good. We're not losing jobs. Yeah. We have wages going up. I would love one of those 3% interest rates that other folks got, but I can deal with a 5 as long as I know I'm not going to lose my job and I'm going to get a nice raise every year.
That's fair. Yeah. I mean, at the moment we would all love that, right? But it's all perspective, and it's all depends on what point of view you have on it and where you are looking at it. So with that, let's answer some more questions. We talked enough about tariffs here. We talked about interest rate projections. I know some of you guys have those in there. I think we've pretty much laid that out at this point. So
we've got a unique one here that I like, Jeb. Let's roll with this. I'm going to throw it to you. Flash of light. Jeb, I'm not throwing it to you. Flash of light is throwing it to you.
All right,
Jeb, do you think housing in the Inland Empire could get crushed if warehouses out there become empty in 2025 due to tariffs?
Warehouses. I mean, how many people move out to the Inland Empire for jobs? Sure, some people do. I mean, that's their job takes them out there, but most people move out to the Inland Empire, at least in my opinion, from an affordability standpoint. They're not moving out there for jobs. They're moving out there and then possibly getting a job when they're out there. Not to say that's everyone, but just how my brain works. I think prices get crushed if inventory goes up considerably, rates stay higher for longer. That's where they get crushed. I don't think they get crushed by empty industrial buildings for the most part. Could that be a part? I mean, could that play? Sure, but I don't think that tariffs are going to make every building vacant. So I don't know. I feel like that's again
think about this,
polarizing questions.
Tell me what your thoughts are on this. We had a comment here where someone's talking about tariffs. Said, hey, listen, just back off, stop spreading propaganda. The people have spoken. Well, the people have spoken with their pocketbooks on this. They no longer like going to the mall. They no longer like going to the store. They no longer like going down to the restaurant. They like things brought and delivered to their door. So most of those warehouses are logistics warehouses. So because we have tariffs, doesn't mean that the American people stopped buying stuff and liking having it dropped on their door 5 minutes later after they bought it. It just means that it's got to come from somewhere else, or it's going to be more expensive. So could there be a decrease in shipping volume? Yeah, but we're not going to have a collapse of the shipping economy just because the prices of imported goods increase.
Agreed. Yeah, I mean, you don't know what these industrial buildings are, right? I mean, I can tell you most industrial at the moment is full, right? I mean, everywhere local industrial is hard to find. What is vacant or what's open and seeing the biggest declines is office space and some retail space and that sort of thing because of the things that Josh mentioned, just less people wanting to do that. But to go back and answer the question in an easy way, no, I don't think that's going to be the case because of a tariff thing. I think it all comes back to supply and demand with housing inventory more so than commercial real estate. This was a good question, Josh. Do you want to add anything to that or no?
No, we're good.
Okay. So I said we weren't going to talk about rates, but this is a different perspective on the same question.
It's the same question I was going to.
Yeah. Has anything that's happened recently changed your long-term 2 to 3 years outlook on rates? Ask me in the morning, what do I want for dinner? I can't even think about what I want for dinner that day. That's too far away for me. I'm thinking about lunch. But what I will say is that I have a bit of a change in perspective on rates. And I've talked about it here. I think we're in this higher for longer era, if you will, and people have been saying that phrase for the longest time, but we've had a lot of volatility and we've seen rates come from 8 down to 7, down to 6, below 6, and now back up 6, 7. I think we're in this time where we don't have any meaningful data that's content. Yes, the long-term trend of employment is going down. It's a stronger economy. Until everything points in the same direction, I think you have this kind of where we are in rates. I don't see a big downward move, and I don't know that we're going much higher from here, but we're just kind of in this space between probably 6.5% and 7.5% interest rates.
I don't necessarily disagree with you on that, Jeb. What I will say is I still have not bought into this. Not higher for longer, because it's been higher for longer, right? You can't debate that at any point any longer. But a new normal of elevated rates.
Yeah,
we talk about COVID era rates were not normal, so throw those out. That run well below 4%. But we had been making a 40-year run down to that 4% range. And you guys have heard me say this about 1 billion times, probably tired of hearing it. The underlying things that were occurring, I don't think that they have changed. And there are really smart people that will say, hey, buddy, from like 2008 on, after the GFC, there was so much government intervention and manipulation. That's gone. So it's going to be different. And there's truth to that. You don't get a replay of the same year over and over again. But I believe 25, 30 years from now, when we zoom out, this will be a blip. When we're living in it, it's certainly not a blip. And I am much more open today than I was 2 years ago to being wrong. I wouldn't wager large sums of money. I'd say 2 to 1 odds. And 2 to 1 odds, you don't play Russian roulette with 2 to 1 odds. You have to play it and imagine as though it's not going to work out the way you think it is with lower interest rates. So you have to be open to all possibilities and play them out in your mind of how your actions will play out under both options.
All right, here's the deal. Audience, Josh, you have no idea that you've frozen. That was your 5th time that you froze. I don't ask the audience for a lot other than liking and subscribing. We need someone to buy Josh a computer powerful enough.
I have a very powerful computer, Jeb.
To work streaming for an hour, 4K streaming. That's it. That's all we need is 1 hour. Broadband, like, fiber. I don't know if we're on fiber here, what we're on. That's all we need. So guys, if you have a computer that you're not using that would support this, we need I need you to send it to Josh. To reach out to me, I'll provide an address. Just don't send us.
Comic Lover says it's you, Jeb. Josh is good. Comic Lover is my friend. That's not my mother.
I haven't seen me freeze, but maybe we're both freezing. Are we both freezing? Let us know. Because then in that case, we're going to need 2 computers. I thought we were going to get away with 1, but we might need 2. Regular viewer here. Hi, my name is Tim. Says, what's your gut tell you about the housing market over the next 6 months? Also, what's your gut tell you about the economy in general? I think the housing market is in a slowdown for the foreseeable future. Again, seasonality is part of it. We've gotten back to a little bit more normal time of the year, but rates are going to push home sales down. It's affecting buyer demand. Homes are going to sit longer. Those that need to sell are probably in a place where they're either going to have to reduce or do something, incentivize buyers in order to make something happen. So I think slower home sales, slower home growth, slower housing market in general. My guess is the spring housing market, which normally comes in about February, is probably pushed off. I don't know that you'll see the February pop, March pop that you normally see unless rates are back down by then. If rates are still where they are now, I think it's a slow grind for the foreseeable future. Rates come down, that changes. So we can revisit that if rates come down.
Well, then take it to its logical conclusion then and tell us, Jeb, is it smart to buy now or do I wait it out?
It's all how you're looking at it. I don't, this is one of those things. Hey, Jeb, you're a real estate agent. It's always a good time to buy. Right now, it's not a great time to buy a house, unless it makes sense for you at this point in your life. I mean, what could make sense of buying now? You've been looking for the last couple of months. You couldn't find the right property. Now the right property's on the market. It's been sitting. There's an opportunity to negotiate it and maybe get it for a lower price than you could a couple of months ago. That could be a good deal to buy it, but you got to be comfortable with the payment being higher than it was a couple of months ago because of higher rates, right? I mean, even though the price might be down, chances are the payment's probably higher because rates are now up. So the benefit of buying now versus waiting is that you lock in the price where it is. You start putting money in a forced savings account. You get potential appreciation. You're still likely to see year over year appreciation moving forward. It's not going to be what it was, but it's probably going to be 2-3% for the next couple of years. So that's the benefit. What's the benefit of waiting? Benefit of waiting is maybe you get the house at a lower price, potentially. Hard to say what happens with rates. Normally the two don't move together. So if you get it at a lower price, chances are there's a higher rate, or maybe it's the same rate today. Maybe, more inventory pops up, you can get a better deal. There's pros to both sides, cons to both sides. It's all relative. You got to do what's right for you. The thing is, you're not missing out on a lot at the moment by waiting a couple of months to see what happens, in my opinion, but hard to say.
I've probably said this a couple times and I'll fall back on it. We have a standard answer and it's never going to change on this show. You buy when it is the right time in your life, when you have a long-term time horizon, steady finances, you can afford it, and you plan on being there for a while. What I will say is there was a whole lot of marry the house, date the rate stuff. Okay, cool. There are strategies for doing that, but you can't use those strategies if you're not okay with the worst case scenario, which is being that is the permanent financing that never gets better. So don't ever let anyone tell you, okay, this sucks, but we got a seller that will pay for a 3-2-1 buy down. So despite the fact that today rates are 8, you're only going to pay 5%. And you look at it and you go, I can handle that payment. Well, next year it's 6%, and the following year it's 7%. And someday in 3 years down the line, it's at 8%. If you're not 100% going to be okay with that 8%, not saying, I hope I get a raise, I hope that side hustle starts going nuts and that replaces my income and I'm making more money. Don't, you can't plan for perfection when you're doing this. So if all the other ducks are in a row, Jeb's right. Is this an ideal time to buy? Absolutely not. But if it is the right time for you, because you were in college in 2020 and couldn't afford, and now you got a wife and a kid, and you're sitting here going, I got to put a roof over everyone's head. Is it ideal? No, but I can handle and manage it.
So let's use me for an example. We've done this several times. Last November, was it an ideal time to buy when you were in it at that time? Was that I went under contract in October. Guess what was happening in October? Rates were 8% last year. So if you would have looked at the market that time and said, hey, was that a good time to buy? Was that the right time to buy? Most people would have said no. I was questioning what I was doing. But for me, right time in my life, needed more square foot in a property, growing, got 3 kids, 3 boys, my wife, myself. We needed more square footage, all of those things. We bought. Rates were higher than I wanted them to be. I was comfortable with the payment, even though I didn't like it. Guess what's happened since then? Rates have come down. I've been able to refinance. Now, I could have waited and tried to buy it now. Guess what the difference is now? There's one in my community that sold for $125,000 more than I bought my property for. One right across the street from me, $100,000 more, and mine's in way better shape than that one is. So I could have waited, probably paid a higher price, and at this point, it would have been about the same rate probably. You just don't know. You don't know what the market's going to do. And sitting here trying to predict it, I'm in the market. I mean, I'm in the business, and I couldn't have told you that home prices were going to go up again in that neighborhood. I didn't think so. But I was okay because it's long-term for me. That's the way you got to be thinking. The problem is data is too available to everyone, and most people don't understand it, and they follow it too closely, without ever looking beyond, a month, 2 month, 3 month time frame. You got to look down the road, 5, 7, 10 years. Where are you going to be? What's it going to look like then? So anyway, hopefully that's helpful. All right, Josh.
This is a comment, not a question, Jeb, but I want to throw it out there just because it makes me smile, it makes me laugh. Comic Lover says, I think rates will start to come down as we hear about the cost cutting from Doge. We actually had a comment on this week's video, someone saying, well, what do you think about putting Elon in charge of this? And you didn't answer. And I put in there and say, I can't speak for Jeb. So I would like to hear your opinion on this one, Jeb. Like, anyone who would sit back and say this is a terrible idea, like, you're just being a partisan. Like, this guy has been successful with many businesses, and he has an intellect. He's an interesting, weird guy, right? People say he's on the spectrum. I don't know that you would want to sit down and have a beer with him, other than to go, just,
I think I would.
That weird genius guy was amazing to watch that in action. But what I'm saying is, the American economy is huge and important to all of us, to everyone in the world. So I'm not saying, what the heck, let's just try it. I'm saying this is a guy with a track record of massive success, and he's not going to go in there and propose insane things. And for now, they call it the Department of Government Efficiency. You can't create a department without the House and the Senate voting on it. So really, it's two guys kind of put in charge of coming up with some proposals of where we could cut some of the fat here. So from the perspective that it still has to go through our American system of passing laws and making changes, I think it's a good idea to get another set of eyes from an outsider to go, hey, is there some waste here, or some things we can cut back? Because we've talked about it 900 times during the election season of the last 12 months that neither one of the candidates were really talking about cutting spending, cutting deficits. They were talking about all these great plans that require spending more money. I think it's great that we're talking about going in and figuring out how we can spend less money. We'll see what comes of it. Maybe nothing, but I like the idea.
Again, listen, if you've got anybody looking at it, trying to cut costs, that's a good thing. I don't care who it is. Like, get some ideas of what you can cut. Like him, hate him, whatever. The guy is outside of the box when it comes to thinking. Very creative, obviously high intellect. I mean, there's probably some things that he'll come up with that are outlandish, and there's probably some things in there that are doable, and so we'll see what happens. The reality is, if they pull from something, it's going to take away from a party that's not going to like it, right? At this point, they gotta cancel something. The only way we can cut the deficit is by saving money on something we're spending money on, right? And that means somebody that's getting that money is not going to be happy with the cutting. Reality with anything, right? Some people are going to love it, some people are going to hate it, and that's exactly what's going to happen when something gets proposed. Some people are going to love it, some people are going to hate it. The reality is, does it actually make sense, and can it get passed? So
I look at it, Jeb, no matter where you turned in the news yesterday, it was anonymous sources here, there, and everywhere. Generally not people on the record saying what a horrific, terrible idea this is. And almost all of those sources benefit from a bloated government that spends a lot of money. So from that perspective, listen, we have no proposals, but someone needs to be looking at it and coming up with proposals of where we could possibly save money.
Agreed. Couple questions here. Let's try to get through a couple, Josh, quickly. This one is Obnoxious Bronco says, they're in chapter 7. How long do I have to wait to buy a home with a 571 credit score? Just in general, let's not talk about the credit score. How long do you have to buy after chapter 7?
FHA is a 2-year waiting period. You're looking at 4 years with a conventional loan. Conventional is going to require you to get above 620. Most lenders are going to require you to get an automated approval, which is probably going to require better than the 620. The important part is, if you just had a chapter 7, you're out of the market for two years unless you have a big down payment and you're doing a hard money non-QM type loan. So in those 2 years, I have seen many people get from a 500 credit score up over a 700. Yeah, this is the time to be talking to a credit consultant that's going to advise you on what to do to rebuild your credit. Because if you do the right things, absolutely could be over 700 in 2 years and you get a great FHA loan. You do nothing, do the wrong things, you'd be sitting there with a worse credit score 2 years from now.
Good stuff. Josh, I'm going to let you read one here. I got to get some water.
Did you have one specifically? So, oh, well, here, this is always interesting. I there, someone pops up and says you'll need a 640 minimum for FHA from lenders. Not true. You've done 57 videos on what the minimum is. It doesn't change after the bankruptcy. It's still going to be the same guidelines. You're going to have to get an automated approval. You're going to have to show you're a good credit risk. So from that perspective,
here we go. I'm good now. An investment property. Can you buy something with 15% down, Josh?
Yes, single family. So condo or single family, a 1-unit property, 15% down is the minimum. I ran this for a client yesterday. I need to follow back up with them today. They didn't like the numbers that got thrown at them. 15% down was like 7.875 with a 1-point cost. And it's going to have mortgage insurance that isn't necessarily cheap. So unless you are getting a spectacular deal on that property, it's going to make the cash flow pretty rough.
All right. Let's see. A lot of questions on rates. I think we've pretty much addressed everything around rates, projections, everything where we think it'll go. Josh, any other? We got some. Hold on. There's another one here, isn't there?
Well, Tracy has one. Who's the best lender for a bank statement mortgage? Bank statement mortgages it's one of the ones where I would say almost by necessity you should talk to a broker, solely because they vary so much from lender to lender. If you go to someone that only has 1 or 2 options, you may miss out on that one that's doing a spectacular special at any given point in time. I have a handful that we trust more than others, but at almost any given point in time, someone's getting real aggressive on that pricing. So check with a broker who can check multiple lenders for you. If you're in one of the states that we can help, we'd love to look at it for you.
Good stuff. Guys, if we can be of any assistance to you, there's a link scroll on the bottom there. You can get in touch with Josh and myself. We can help you with mortgage and real estate. If you want to be on the Rate Watch, jebsmith.net/Rate Watch. In fact, depending on where you're watching this, there's a link in the description of the video that will get you to us. Until next week, guys, buy right, borrow smart, build wealth. Adios.
Amigos.